All right, let's just dive right into this. Right now, some of the absolute most valuable, most recognized companies on Earth are practically racing each other to do one very specific thing: sell you their stock. I mean, we are witnessing an absolute frenzy of IPOs, initial public offerings. Now, to a lot of folks, this looks like a massive celebration, right? Like the doors to the greatest tech boom in history are finally swinging open for everyday investors. But if you actually look deeply at the data, this isn't a celebration at all. It honestly might be a trap. Welcome to our explainer. Today, we're going to look really closely at this fascinating pattern playing out in the stock market right now. It's basically a silent signal that the smart money is literally sprinting for the exit. So that brings us to the core mystery we really need to solve today. Look, in the stock market, an open door is never just a favor. Generosity doesn't really exist purely out of the kindness of someone's heart. Every single trade needs a counterparty. If you are buying a stock, well, someone else has made the very calculated decision to sell it to you. So if these companies are truly the future, why on earth are their founders, their early employees, and their venture capitalists in such a massive hurry to unload their shares onto you? Well, it all comes down to a concept called information asymmetry. When you strip away all those flashy headlines and the Wall Street ringing the bell celebrations, an IPO is fundamentally a trade built on completely uneven ground. See, the sellers in this scenario, they are the most informed people in the room. They built the company, they see the daily metrics, the internal burn rates, the raw data that you and I will literally never get access to. By definition, the buyer, which is usually the retail investor, is the least informed. So these insiders have looked at the most exciting companies of our lifetime, run the numbers, and quietly decided that they'd rather have your cash than hold on to their own stock. You know how in poker, a tell is that unconscious little signal that gives away a player's true hand? Well, financial markets have tells too. And you don't find them by watching cable news, you find them by watching what people actually do with their money. The average retail investor often acts on emotion. They tend to sell when they get scared, like when the news turns bad and the chart drops. But the professionals? They do the exact opposite. They are looking for those moments when the hype is at its absolute loudest, and that is when they make their move. This whole dynamic is perfectly captured by Benjamin Graham. He is the father of value investing and actually Warren Buffett's mentor. He famously said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." Think about that. The smart money sells when everything looks absolutely perfect, when the optimism is just off the charts and there's literally a line of buyers out the door begging to get a piece. Why? Because that is the exact moment you can extract the maximum amount of money for whatever it is you're selling. Which brings us to Section 1, the Dine and Dash, a historical market tell. The historical precedents here are honestly staggering. Let's look back to 2007, right before the global financial crisis. The founders of Blackstone took their company public and walked away with something like $2.6 billion in cold hard cash. Just a little over a year later, the market crashed and Blackstone's stock plummeted by roughly 90%. Insane, right? Fast forward to 2021, and the tell wore a slightly different costume, the SPAC, or blank check company. In just one single year, 613 of these things went public, raising over $160 billion, basically skipping normal IPO scrutiny altogether. And the result? Companies that completed a SPAC merger in 2021 lost 67% of their value on average. But the most famous example of all takes us all the way back to 1999. The aftermath of these insider exits is what's truly devastating. Back in 1999, tech companies made up a record 51% of all IPOs. Everyday retail investors thought they were buying a piece of the digital future. But right after the insiders got rich, the dot-com bubble popped. An estimated $5 trillion in market value just evaporated. The Nasdaq crashed more than 75%, and according to data from the Kauffman Foundation, 10 years later, only 29% of those emerging growth companies were even still standing. The asset people thought they were buying simply ceased to exist. The pattern is super clear here. When markets are booming, insiders sell. When they aren't, they don't. Moving on to Section 2, the AI spending gap. So if this cycle repeats itself time and time again, we've got to follow the money in today's massive AI boom. And it really boils down to two numbers. The first is spending. This year alone, the largest technology companies on Earth are projected to spend a jaw-dropping $725 billion building out AI infrastructure. That is a 77% increase from just last year. We are quite literally looking at the largest and fastest infrastructure build-out in human history. Now, I know it's incredibly hard for the human brain to really conceptualize a number that large, so let's try to put it into perspective. If you spent $1 million every single day, starting from the day Jesus was born, going all the way through the fall of the Roman Empire,
The Middle Ages, the Renaissance, both world wars right up to this very second. You still would not have spent what big tech alone is going to spend on AI just this year. I mean, it breaks down to roughly $23,000 every single second. Absolutely mind-blowing.
But there is a second number that defines the AI industry right now, and it's the total amount that all of this unprecedented spending is actually earning back. Over the past 12 months, the entire AI economy combined generated an estimated $110 billion in revenue. And keep in mind, that's just revenue, not profit. When you actually put those two numbers side by side, the imbalance is frankly dangerous. The entire AI economy earned back an amount equal to roughly 15% of what big tech alone plans to spend this year. By literally any traditional financial metric, that is a massive, incredibly dangerous gap. Now, you might be thinking, well, surely the businesses actually adopting AI are seeing great returns, right? Actually, the data says otherwise. A recent Deloitte survey found that while 74% of organizations want AI to grow their revenue, only 20% have actually seen it happen. And it gets even more shocking. Researchers at MIT looked at hundreds of real corporate AI rollouts. We're talking actual companies spending real money, and they found that a staggering 95% produced absolutely zero measurable return. Zero. All right, let's jump to Section 3, Pricing for Perfection, the OpenAI teardown. So OpenAI is obviously still private, but their recently leaked financials reveal a pretty stark reality. Last year, they brought in around $13 billion in revenue. Sounds great, right? But they nearly tripled that in losses. And they're projecting a massive net loss of $38.5 billion for 2025. Internally, they expect to burn well over $100 billion by 2029. Yet, despite these staggering cash-burning fundamentals, their latest valuation sits at a monumental $85 billion. That is more than 65 times its revenue. The market isn't pricing this company based on its current on-the-ground reality. It's riding on pure, blind optimism. It is quite literally pricing the stock for absolute perfection.
Which leads us to our final section, Section 4. When the music stops.
To truly understand how insiders navigate a market that's priced for impossible perfection, we really have to look at this infamous quote. Back in the summer of 2007, right before the global financial system nearly collapsed, Charles Prince, the CEO of Citi at the time, was asked about the bank's super risky lending. And he said, when the music stops in terms of liquidity, things will be complicated. But as long as the music is playing, you've got to get up and dance. We're still dancing. He wasn't saying the party would last forever. He knew for a fact it wouldn't. He was basically admitting that the market is just one giant game of hot potato. And here is exactly how this game of hot potato plays out in real time. Step 1. Prices sprint miles ahead of the actual fundamentals. Step 2. The founders and the insiders realize that the market has priced their companies for a future where every single bet pays off perfectly, which we all know is impossible. Step 3, because they're stuck in a crazy expensive AI arms race and they don't know exactly when the bubble's going to pop, their absolute most rational move is to pass that hot potato to the biggest, most eager crowd of buyers they can find, which is the retail stock market. And finally, step 4, eventually, gravity takes hold. The fundamentals always catch up. Look, no one has a magic stopwatch here. No one can give you the exact date the fundamentals are going to catch up. Could be in a month, could be a year, could be 3 years. But the reality is, you don't really need a date. You just need to be able to read the room you're standing in. The market tell is flashing right in front of us. The smartest, most informed people in the room are rushing to pass you the potato. So, as you look at all these shiny new IPOs, you've got to ask yourself, are you reading the room? Because trust me, you definitely do not want to be the last one left on the dance floor when the music finally stops.